Hi, everyone. Welcome to helping investors navigate volatility, inflation, and rising rates in bond portfolios. This is indeed one of the toughest bond market environments that we have seen in years. There is, however, a potential silver lining to the cloud that we have experienced, and we're going to talk about that today. We are also going to address a couple of frequently asked questions. But first, let's start with fundamentals. And in many respects, a bond is simply a loan. Governments borrow money in the bond market to build bridges and tunnels. Companies borrow money in the bond market to invest in people and equipment. Here you see a simple illustration of a 2-year note that one of these entities might use to borrow money. The price is $100. This note pays out 2 semi-annual coupons of $1 each year. Yield to maturity, which is an estimation of future return, is calculated to be 2%. How is it that this simple security can cause so much heartburn in the markets this year? Well, the short answer is that, like the price of a stock or a piece of real estate, the price of a bond can move up and down, and that has surprised some investors. Let's walk through an example to see how that works. Let's say that after I buy that 2-year note that we just saw at par for $100, interest rates fall to 1%, as shown here in green. Am I happy? You bet. I have a note in my possession that pays a 2% yield when comparable notes pay only a 1% yield. I am quite happy. In fact, other bond investors would likely pay me a premium for that juicy 2% yield if I went to go out and sell it. Here we see that they are willing to pay me 101 spot 97. If, on the other hand, I buy my 2-year note and then I see that the yield on comparable notes moves up to, say, 4.6%, I am now quite sad. My 2% note is now yesterday's seafood special. Investors would only pay me 95 spot 13 if I went out to sell it. It is this relationship between bond prices and yields that underlies the seesaw concept that many of you may be familiar with. If interest rates move up, bond prices move down, and vice versa. If interest rates move down, bond prices generally move up. And indeed, as interest rates have moved up in recent months, you've seen this teeter-totter relationship play out in bonds and bond fund values. But the other important thing to remember as you review your monthly statements, however, is that there are 2 components of return to your bond investments. First, the price return, and prices can change in a given day or week, as we just saw. But second, and arguably more important for many types of bonds, is the coupon return. Over the last several decades, over 90% of the total return in a commonly referenced benchmark for the U.S. bond market has come from interest payments and the reinvestment of interest payments. Okay, we've covered some important concepts, but let's get more specific. In 2022, we've seen one of the toughest starts to a year for bonds in decades. What is going on? Well, in a word, inflation. Many of us see inflation every day when we fill up at the gas pump or when we visit the grocery store. There are a number of factors driving inflation. The tragic events in Ukraine have impacted grain, oil, and other commodities. COVID-related supply disruptions have impacted manufacturing. Inflation is now a challenge across the financial markets. In bonds, inflation erodes the purchasing power of the coupon and principal payments that you expect to receive far into the future. The Federal Reserve sets the target for U.S. short-term interest rates. The Fed has a dual mandate. The Fed seeks to foster both full employment and price stability. The job market is strong these days, but on the other hand, the Fed is keenly aware of the steady pain that consumers are feeling from inflation. Consequently, that price stability mandate is taking priority in their decision-making. Financial markets are now bracing for a series of rate hikes as the Fed seeks to tamp down on inflation, and that is what is driving yields higher in the bond market. Historically, short maturity yields, and here we are graphing the yield on a 2-year Treasury note, have moved in rhythm with the Fed funds target. But what is really remarkable is how in 2022, the bond market has sort of done the Fed's job for them. They have really ripped the Band-Aid off. Yields have increased quickly in anticipation of rate hikes. And this gets to the heart of our discussion today. On the one hand, this move up in yields creates price movement, as we saw earlier. But on the other hand, this cloud has a silver lining. The move in yields improves return prospects for investors over the medium term. Let's tackle a question that some are asking these days, and that is, should I allocate to bonds at all? Each investor is different, but bonds can be beneficial for many types of investors. Bonds play three roles in a portfolio. One, defense. They help to preserve principal. Two, bonds generate income. And three, bonds help to diversify equity and other risk investments. Bonds tend to zig when other markets zag. Bonds have important capital preservation characteristics. U.S. government bonds are backed by the full faith and credit of the U.S. government. Corporate bonds, as you can see in this picture, also have legal and structural benefits. In the event of a stress event, for example, senior bondholder claims tend to be paid before those of other investors in a corporation. Sometimes bondholders have claims on specific hard assets, like real estate or airplanes. And it is so important to remember the power of interest income, as we mentioned earlier. In fact, historically, the correlation between starting yield and subsequent 5-year returns for, say, high-quality U.S. core bonds has been 94%. This chart here shows you the yield on a number of key segments of the bond market, including core U.S. bonds and corporate bonds. Look at how these yields, shown here as of the end of April 22, have now reached levels that are more attractive than those that we encountered in 2021. You can now earn 3.5% yields in core bonds, 4% yields in corporate bonds, and 6.5% yields in high yield bonds. Value in the municipal bond market has also improved. You can now earn a 3.1% yield in the muni market, which translates into an over 5% yield when you factor in potential tax advantages. And as we saw earlier when we looked at the 2-year Treasury, short maturity yields in particular have edged up. These days, you can earn attractive yields by investing in short duration or low duration bonds. With short-term or low duration bond funds, you do take on some modestly higher volatility or credit risk, but the yields available in this space are higher than those available to investors in bank savings or money market funds, which may not have yet priced in the Fed rate hikes to the same degree. This is a potential sweet spot for investors that are looking for an attractive trade-off between yield and risk. To sum up, this is a challenging environment for bond investors. We saw, however, how income is such a key driver of long-term returns in bonds. And in that regard, today's higher yields should really help. An allocation to bonds has historically provided investors of all stripes with income, capital preservation, and diversification benefits. Thank you for your time. For additional information, please visit us at PIMCO.com.